Hey there, and welcome. Have you ever looked at the stock market and felt like picking a winner is just pure guesswork? Well, what if I told you it's a lot less like buying a lottery ticket and way more like cracking a case? Today, we're going to put on our detective hats and learn a step-by-step framework to uncover what a company is really worth.
So this is the big question, right? Is investing just a shot in the dark, a total gamble? Or is there a method to the madness? Is it more like a puzzle that, with the right tools and a bit of detective work, can actually be solved?
You guessed it. We're going to treat it like a solvable case. We're officially becoming investment detectives. And our method? We're going to follow a top-down approach, starting with the biggest picture clues, like the whole economy, and then narrowing our focus all the way down to the nitty-gritty details of a single company.
Okay, but before we dive into our first case, we've got to gear up. Every good detective needs their toolkit. And in the world of investing, the two most fundamental tools you have are risk and return. You just can't solve anything without them.
First up, let's talk about the good part, return. This is basically your reward, the potential payoff for all your hard work. And it comes in two flavors. You've got income, which is like a regular paycheck from your investment, think dividends. And then you have the capital gain, which is the profit you make when the price of the investment itself goes up.
Now for the other side of that coin, risk. You know, this is the suspense, the uncertainty that hangs over every single investment. It's that nagging possibility that the return you actually get won't be what you were hoping for. It's the chance you could lose money.
And this chart shows the fundamental rule of the game. It's called the risk-return trade-off. And it's simple. If you want a shot at higher returns, you absolutely have to be willing to take on more risk. You see it right here. Safe stuff like government bonds, low return. Riskier things like small-cap stocks, well, they have to offer the potential for much higher returns to even be worth considering.
But here's a pro tip. Not all risk is created equal. There are two main types. You've got systematic risk. Think of it like a storm that hits the entire city. A recession, inflation, you can't really dodge it. Then there's unsystematic risk. This is more like a problem at one specific house. Say, a company's big new product is a total flop. The cool thing is, you can actually protect yourself from this type of risk by diversifying, by not putting all your eggs in one basket.
All right, we've got our tools. Let's start the investigation. And the very first thing any good detective does is survey the scene. For us, that means getting the economic weather report, looking at the big picture.
So why do we start so broad? Well, this slide nails it. You could find the absolute best, most well-run company in the world. But if it's on a sinking ship, meaning the entire economy is tanking, it's probably going down too. The economic tide lifts or sinks all boats.
So what are we looking for in this weather report? We're looking for key clues. Things like GDP, to see if the economy is growing. Inflation, to see if prices are getting out of control. We keep an eye on interest rates, unemployment, even what the government is doing. Each one of these is a vital clue about the health of the entire market.
And you know, economies don't just move around randomly. They tend to follow a pattern, what we call the business cycle. It goes through an expansion, where everything's growing, hits a peak, then a contraction, or a recession, and finally a trough before it starts all over again. A smart detective who can figure out where we are in this cycle has a serious leg up.
Okay, so we've got a handle on the overall economic climate. Now our investigation can start to zoom in a little. We've surveyed the city, now it's time to find the most promising neighborhood. In our case, the right industry.
And just like the broader economy, industries have their own life cycles. They often start in a risky pioneering phase, then hopefully hit a period of rapid growth. After that comes a more stable, mature phase, and eventually many industries start to decline as new technologies take over. Figuring out where an industry is on this timeline is a huge clue about its future.
And of course, different neighborhoods behave differently. You have growth industries like tech that just seem to grow way faster than everything else. You've got cyclical ones like auto manufacturing that do great when the economy's booming but really struggle in a downturn. And then you have defensive industries, think utilities, that are pretty stable no matter what because, well, we all need electricity.
And here we are, the final stage of our investigation. We've checked the economy, we found a promising industry. Now it's time to get out the magnifying glass and investigate our specific subject, the company itself.
This, right here, is the absolute heart of what we're doing. This whole process is called security analysis. It's all about digging deep into a company to figure out its true intrinsic value, what it's really worth, completely separate from the wild up and down price you see on the stock market every day.
So how do we do that? Well, our detective uses two lenses. First, there's qualitative analysis. This is the story. How good is the management? How strong is the brand? Then there's quantitative analysis. This is the hard evidence, the cold hard numbers from their financial statements. We're talking profits, debt, the whole shebang. You really need both to see the full picture.
So imagine we're digging through the numbers and we find a clue. We calculate the company's price-to-earnings ratio, and it's 25. Okay, we found something. But so what? What does 25 even mean?
See, a clue by itself is pretty useless. It only starts to mean something when you have context. So here, we see our company's PE is 25, but the average for other companies in its neighborhood is only 20. Aha! Now we've got something. This tells us the market is valuing our company more highly than its competitors. And that leads to the million-dollar question for our detective: why? Is this company really that much better?
So we've gathered all our clues, from the economy, from the industry, and from the company itself. Now comes the best part of any detective story: putting all the pieces together, solving the puzzle, and cracking the case.
This is the moment of truth. After all of our detective work, we come up with our own estimate of that company's true intrinsic value. And the final verdict is simple. If our value is higher than the current market price, it looks like it's undervalued, a potential buy signal. If our value is lower than the market price, it seems overvalued, a potential signal to sell or at least stay away. This is the whole point of the exercise.
And this right here is a perfect recap of our whole method. It's a funnel. You start broad with the economy, then you narrow down to a specific industry, and finally you zoom all the way in on a single company. Following these steps ensures you're building your case on a solid foundation. Now, it's really important to remember that this entire process we just walked through, that's security analysis, that's solving one case. But building an entire portfolio of investments based on your findings, well, that's the next level, and that's the art of portfolio management. So there you have it. That's the Detective's Guide to Investing, a top-down framework to investigate any potential opportunity. You now have the toolkit. The only question left is, what case are you going to solve first?